For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. All right, welcome back. Hey, this is fantastic. I am excited today. I am very excited because why am I excited? First of all, I'm your podcast host, Johnny Dean. Welcome to Managing Your Financial Future. And I'm excited because I believe we have a new intro. Professor Rick Plum, you're here with me.
I am here.
As always, Professor Rick Plum, certified financial planner, professional,
Yes.
CFP type. Yeah, here with me. And so that's the other fun thing. But not only do I have you here, I'm surrounded by more,
It's wonderful. We've got a couple of additional advisors to get additional perspectives on different topics right today. So it's going to be a fun day. I get to listen to where they're coming from.
Well, we love to get the perspectives of other financial advisors. Now, these folks are all part of the Lucia Capital Group family, so they're all on the same page, and they all work with you, Professor Plum. But first of all, we've heard from this guy before, and we've got him back. I mentioned this at the end of the program, Jonathan Savona, who is also a certified financial planner professional, CFP. Hello, Jonathan.
Hey, guys. Thanks for having me back.
Well,
you are spoiled today.
Well, I am. I really enjoy getting the perspectives of advisors, and I'm happy to do that. And not only that, we got another guy here who, now, I don't know, Ronnie Sanchez, who's a wealth manager at Lucia Capital Group. Ronnie, say hello.
Hello.
There
Thanks
you
for
go.
having me.
Good job. You
Appreciate it.
You did very well.
That was challenging.
It is challenging, isn't it?
Is this your first time with us?
On the podcast, yes.
Okay. Just wanted to.
Okay.
I thought so, yeah.
All right, yeah.
Well, cool.
Yeah.
Now, Ronnie and I, we work together quite a bit, actually a little bit more than Jonathan and I work together. I work with both of them. I just work a little bit more with Ronnie than Jonathan at times.
Oh, okay. Because
Right.
Jonathan's got an office like right next to yours.
Right.
So anyway, what we're going to talk about here today with these guys is we are post-tax time here, obviously. Well, and not for everybody.
Not in California necessarily.
Yeah, if you're listening in California, you got an extension on your taxes, which takes you out to October.
Yeah.
Like what, 18th, 15th, 16th,
16th.
something like that?
And parts of Georgia and parts of Mississippi, I think.
Yeah, there's certain areas where there was a disaster relief extension, something like that.
Right.
So, but I mean, for the most part, we're post tax time, and one of the things that financial advisors will do is help you tax manage. They manage your taxes for you. Now, Jonathan Savona, as we've talked about with Professor Rick Plum, you do not actually do people's taxes.
Right, but it can open up a conversation of their, financial picture, different things we can organize, things we can recommend. So we're always asking to see the tax return or read off tax numbers.
Yes.
And this is the time of year where it's on our top of mind. So
Yeah.
it's a good topic.
And generally,
actually, this is when people actually have their tax returns because they'll get it back from the accountant. Right. They'll file their tax return, and then they'll file their return away, and they forget where they put it. So for us to ask for the return now means we might actually see it.
It's on the desk.
Yeah, so there are some things that you wanted to talk about that you mentioned to me, and you said, well, there are certain things that you see when meeting with clients post taxes or just during tax time that you notice, things that either they're not doing or they are doing or they could be doing. So let's just jump into this right away, Jonathan. What sticks out mostly to you when you look at somebody's tax return after they've already filed it?
Sure. I mean, I hope it's helpful to kind of take a step back and think through what the tax season, gave us, whether it be how well we did, how poorly we did from our expectations, our CPAs, our tax preparers, how well they did or didn't do. I thought it'd be a good time to look at things that have come up that are new, things that we see all the time. So I'm kind of a public address here just to give some reminders.
Sure.
I have a few things written down, but Ronnie and Rick and I go through this every day. We're talking to clients about tax return and how to prepare. And
that's true. And one thing Rick brought up, and I don't know how important this is, but Rick, you just brought up before the show, was how many people are paying penalties.
Right. When we go through a return, one of the first things I'll do is look to see if they paid a penalty, and if they did, why. And is this a one-time thing, or is it a chronic issue? And I've said it before, I don't necessarily like paying the taxes that I have to pay. I mean, obviously, I will pay the taxes that I have to pay, but I don't want to give them any more money in the form of a penalty. And so that's an area that I kind of, even if it's only, $50, $100, $200, whatever the penalty is, I don't like it.
Now, what kind of penalties are we talking about here?
I mean, these are small penalties. If you under-withhold throughout the year, the IRS requires some type of ongoing payment into the system. Quarterly, it could just be
withholding
as you get paid. But yeah, I mean, I have some clients who are fine paying penalties. They don't want to give the government anything as soon as possible.
Them more.
They'll wait as long as they can to do that.
Okay.
Now, a couple of years ago, I was less of an issue with that because, so I'm putting the money in my bank account and it's earning me nothing. Now I'm more on that side because at least I can earn something in the bank account that I have because we've got a little bit of interest rate back. So I can almost buy into that a little bit more. But I just don't like giving the government the money.
Well, it's true,
ever.
though. For some who've sold a home or have bigger taxes to pay, they have cash waiting to pay the tax, but now they have an extension. In California, they have that extension till October. So there's some taking advantage of that, buying a treasury or CD, and they'll make some interest on that before they pay taxes. And that's fine with them.
Oh, sure.
That works for me, too.
Oh, heck.
Now I'm using it to our advantage. I mean, the individual's advantage rather than the government. And we know how responsible the government is with that.
But this is a rare thing. I mean, we don't get extensions like this automatically. So, I mean, part of it is every year we need to be aware of where our tax documents come from. Are we paperless? Do we have our address set up properly? Did we move? I think some of it just being organized early in the year, and that covers a lot of questions.
All right, so you see penalties from more often than you'd like.
From under withholding. I like to look at, especially if I've got somebody who's younger, either they're doing a 72T or something of that nature where they're taking money from their IRA, and they think they're doing it at a point where they're not getting penalized, but they're still showing a penalty down below. And that usually tells me there's a miscommunication somewhere. And that is one of the bigger areas that I find the problems with the tax preparer. Isn't that the tax preparer makes an error necessarily. It's that the person didn't tell them that they were doing something. And so the accountant didn't know about it and didn't know how to, didn't know to account for it.
Yeah, how do you do this? Because as I said before, you don't do the taxes. You can advise somebody about what they're doing on taxes and how they should do things, but it's really up to the individual person to take that information that you give them, any one of you folks here, and relay that, or at least let their CPA in on the conversation. Is this where a lot of this breaks down, Jonathan? Do you see that?
I guess one example would be the funding of an IRA, especially when the deductibility of it is in question. And so you might need to unwind. You might be doing Roth conversions of non-deductible contributions. There needs to be communication behind that to the tax preparer, because we don't run the taxes on our side. The clients might not be aware of the strategies that we've put in play. And so there's three different levels of communication that need to happen. But this is one that I do see that affects people when they're funding a non-deductible IRA, meaning you make a little too much to fund it and get a deduction, but you take that and you're able to convert that to a Roth. There's some miscommunication behind that for the tax preparers.
Right. So if you're doing what's known as a backdoor Roth IRA,
right,
you do need to account for it on your tax return. Now, it doesn't show up on the physical 1040 tax return. It shows up on the supporting reports that shows what's happening. And you need those supporting reports so that the IRS doesn't get all...
Well, just letting the taxpayer know I funded my IRA. Sometimes there's not a document to tell you that.
Right. Well, yeah. If you're not doing the backdoor, all you're doing is funding an after-tax IRA, traditional IRA. You still need to tell your accountant that you made a non-deductible. Say, I made an IRA contribution. Most likely, your accountant is going to come back and say, that wasn't deductible. Are you sure you made an IRA? Yes, I did. Because now the accountant has to track it and keep so that when you ultimately take money out of the IRA, you don't have to pay tax twice. But
it's an important thing not to pay
know
tax
that
twice. Yeah.
You know that you don't get to deduct it, so you don't even tell the accountant. But you need to be able to keep track of it so that someday, when you take the money out, you can avoid that additional tax then.
Now, Ronnie Sanchez, what have you seen with this? Go ahead.
I'm just curious how much communication there is between the client and the CPA. It doesn't seem like there's much. It seems like there's a lot of data entry on the part of the CPA, not a lot of talking, because very simple mistakes come up all the time. A very simple phone call would cure that. Doesn't seem like that's happening too often.
A phone call from
the client to the CPA to explain a very simple instance.
Well, a lot of times the tax preparer is inundated. And so they just say, drop off all your stuff, and they take the information, the W-2s, the 1099s, and all that, and put it into the computer program. But they don't have a lot of, unfortunately, they don't have a lot of interaction with that person. Now, for a lot of people, it doesn't matter because they're fairly straightforward. There's not a lot they can do. But if you're doing some of these other things, one of the bigger ones that Jonathan and I know have both talked about, Johnny and I too, are QCDs, qualified charitable distributions. If you don't tell your tax preparer that you did a qualified charitable distribution, there is no way they know it happened, and you're going to get taxed on that distribution.
There's no coding on the 1099s.
There is no coding.
Now, there are potentially accounting documents from the charity, which I've heard and seen that they're getting a little bit better in telling you or telling the tax preparer that it came from an IRA.
Right. They send you the receipt, basically.
There's some developments on that side of it.
Well, hopefully, because, as you said, the 1099 does not have anything on it that says this was a gift to charity or this amount of money went to charity.
In a QCD, 70.5, you can give from your IRA up to $100,000 per person to charity without it being taxable.
Yeah, and it's one we're seeing a lot more of now as strategy, I think, than we did 10 years ago. Could we even do it then? I don't remember.
When did QCDs come out? It's
been
about
5-6 years.
Yeah, it's been out there for a little while.
Right. So the idea is to send money if you have a required minimum distribution. You send, or you don't have to, but you could send that required minimum distribution directly to the charity, and you don't take possession of the money. I mean, for some people it's a wash, but it really, and we talked about this before, doing it this way, sending the charity money directly from the IRA is really, there's no downside to doing it that way, and there may be a lot of upside to doing it that way.
I mean, it could reduce Social Security taxation. It could help you with Medicare, tax limits. So there's a lot of potential benefits.
But if they're not doing it right, or if the CPA isn't informed that then the CPA is just going to see a 1099 that says, "Oh, look, $8,000 came out of this IRA. Boom, I'm going to put it on the tax return," when it shouldn't have been on the tax return.
Wow, I just looked up QCDs. They've been around for a while, since 2006.
Wow, goodness. Well, there you go.
We're way off.
I don't remember even talking about them until about 5 years ago, but that's okay. That's all right. All right, so that's another thing. And again, it all comes down back to communication. Is that correct?
The communication between you and the advisor, or communication between you and your tax preparer, and sometimes communication between the tax preparer and the advisor, so you're all on the same page of what's happening. But like in everything else, communication is pretty much key.
I mean, we try to communicate and prepare clients that here's what you should receive, here's how well last year went or how poorly last year went, just to create some expectations so they're not totally off in left field for taxes. It hopefully prepares them enough to feel confident when they start the taxes.
Yeah, because it seems to me that the person, the conduit, I guess I'll say again, is the client, really. Because let's go back to the example of an IRA. You make an IRA, a contribution to an IRA. Now, the client, when you do this from your end, the advisor's end, they should know whether it's a deductible or non-deductible contribution, correct? I mean, this is what you guys make clear.
We try to, yes.
Yes, and well, it's kind of an important thing.
And there are times, though, where they're borderline. We don't know whether they're going to qualify for it right up the front. So we usually try to get a little closer to tax time before we actually do the contribution. But
so now the client is supposed to kind of know, well, I made a $3,000 contribution to my IRA. The client kind of needs to know whether it's deductible or not. Is that correct?
Well, it's very important because
to tell their CPA
from a deductible, non-deductible IRA contribution, I can't imagine. I personally don't know of a reason why I would want to do a non-deductible IRA contribution if I can't do the
two-step, yeah.
Now, other than the two-step, I wouldn't necessarily want to do. Yes, you can make a contribution to an IRA regardless of your income, but there are limits. If you're a participant in a retirement plan at work, there are limits to whether you can deduct that contribution. And that comes in a point where if I can't deduct it, what's the use? I don't really want to do it.
Well, and even when you provide the right information, it might not go right on the tax return. As I was telling Rick and Ronnie and John here, I've had a couple of situations this year where the IRA was clearly a taxable
it was a rollover from a 401k.
That might have been a different scenario. This was a systematic withdrawal from an IRA. I think that was the conversion, the Roth conversion, but systematic withdrawal from IRA. Clearly taxable. It has been for years. All
like
of a sudden,
72T kind of thing?
No, just a distribution.
Regular
just a
distribution.
Okay.
All of a sudden on the tax return, it's not taxable, and it didn't make sense to me. And I'm digging into the tax return. There's a form called 8606 form, and all of a sudden this client has a $500,000 basis in their IRA, which doesn't make sense. That means you've funded your 401k over the years. Your IRA never took a deduction, and you get all that tax-free on the way out. And for most people, that's not the case.
A $500,000 after-tax component, I can't imagine how you would ever get that.
So I saw it twice this year, and they've had to go back to the tax preparer, and they didn't know why it ended up that way. So some of it has to be a sniff test. Does this even make sense to me? Is it taxable? Wow. Is my income way different than last year, whether higher or lower? Ask the question, at least.
The problem with that one is we really want that one to be true because we want it to be non-taxable.
Sure.
And so we may not look into it. When I say we, I mean the individuals. We don't want it to be taxable. We don't want to look a gift horse in the mouth. So we'll just let them keep. My accountant said I could take this non-taxable. It's like, I'm not going to question it.
Well,
you kind of have to, because if you ever get caught, it's not the accountant that's going to have to make the back payment of tax. It's you.
No, it's the whole situation we've talked about before is garbage in, garbage out as far as a CPA goes. And really, I think as far as a financial advisor goes to some degree, although you guys as advisors presumably would have access to the different statements that people have. You know which questions to ask somebody. A CPA who's doing somebody's taxes may not have any clue which questions to ask. I mean, there are too many. There are too many questions for a CPA to say, well, what's your basis in this? And I mean, they don't have time for that stuff.
Well, so many people are doing TurboTax, doing it on their own as well.
That's another one. That's
true. They shouldn't be, but they are. And so you try to save them after the fact, but I mean, they're doing it on their own. So
well, and as efficient and as good as I think TurboTax is at asking which questions, they don't always hit it. They can't. They can't.
Taxes in some respects is a completely different language. So they may be asking the question, but if we're not understanding the question, we may give a wrong answer.
So you've got two different things. You have the planning side and the tax management side, which develops a plan for this person that you think is the most tax efficient over the long haul way to do things. And so this plan needs to be communicated to the CPA. And where you guys are seeing some of the drop-off or some of the problems is in that communication. I mean, I think we've made that clear here in this episode.
Right. And unfortunately, you have to have a little bit of background. Hopefully, you're learning a little bit of background from this podcast about what's happening, because a lot of people don't want to know what their taxes look like. They just want to know, am I getting a refund? And so here's my stuff. Tell me I'm getting a refund. I'll file this away. I'll never even look at the darn forms. But this is where the knowledge is power type thing comes in. If you know a little bit about what's happening on your tax return, you may be able to get a bigger refund or pay less when you actually file.
Well, that's absolutely true. And just from hanging out for all these decades as I have been, I kind of know what to look for when I'm doing my taxes. And I think, well, you know what? I do it this way. I'll plan this way, and then I know what I'm doing. But as you said, many people just want to take a bunch of receipts and drop them off at the CPA, or just, go through them line by line when they do their own taxes. Ronnie, have you seen that?
Yeah. I was just telling Rick this morning, I think that as people get older, it's the same way that they treat their portfolio. They don't necessarily care anymore, right? They don't want to know the ins and outs of what they're doing. They want to basically put it on us. Let us worry about all of it.
Well, and that's why you're there.
It's the same for taxes.
Yeah.
They just, like Rick said, they give the documents over to the CPA. CPA does data entry for the most part, no communication whatsoever, and then they get what they get.
And I understand that. I really do, especially as I get older. I'm not, I'm not Methuselah yet.
You're not me.
But, no, I'm not you, Rick.
Well, we don't want to be too negative on tax preparers. They do a good job.
No. I'm not.
Right. CPAs, we need them. We obviously
Absolutely.
need them. People
Yeah.
need them. But, we just need to be aware of where the drawbacks land.
Well,
the
and that's
landmines.
true. And I'm kind of saying, well, I see how people, clients can be just, you know what? I want you guys to do my tax management for me. Explain to me what's going on, but handle it all for me if you would. I just don't. I want to go live my life, and that's what you do, and that's one of the great benefits of having a financial advisor. And I think when it comes to taxes, as Ronnie Sanchez just said, it's like, okay, here's some stuff, Mr. or Ms. CPA, take it away. I'll come back in a couple weeks, but that can lead to problems, as we've been saying. Which is that, hey, you know what? You may be missing quite a bit of either deductions or you may be overpaying your taxes. So there's a disconnect here.
There is. And so the idea is,
what do you do?
have at least a basic understanding of where your income is coming from and what's happening. And, understand that your tax return, there are some moving numbers in there. There are some moving parts. And whether you can move it for this year or not, by the time the tax preparer gets it, there's probably not a lot they can do to move the number one way or another, but looking forward to the future, we can maybe make some differences. I was meeting with somebody the other day who was like, I think my tax preparer is fine. They do the accounting very well, but they don't help me save anything. And I said, well, okay, let's take a look at your tax return. And the reality was there wasn't a whole lot to save. I mean,
You save as far as
for paying taxes.
Save taxes.
There wasn't
Okay,
a whole lot they could do
Yeah.
because their income was their income, Social Security, pension, and then whatever their investments and IRA distributions are. They didn't have that much in personal investments, so it was Social Security, pensions, and they were taking money out of their IRA. The only way to affect your taxes on this is reduce one of those numbers. Well, that's not going to happen. They need to live.
Yeah. You
So
have
it doesn't always, if you don't understand how the tax return works, you can create anxiety and you can create almost a divide between you and your tax preparer because you don't think they're doing it. And in his case, tax preparer was doing a pretty good job, doing exactly what counting was perfect. But
you just have to know what to. Well. So you bring up a good point here, which is, Professor Plum, that this is taxes are really income tax, right?
Mm-hmm.
So really, what you have to know is, as you just said, what is my income and where is it coming from?
Mm-hmm.
Would that be a big step for people to maybe
we have
get a better
different-
handle on this?
Sure, we have those who are working, and so their income might be relatively straightforward. They might be self-employed, where you've got levers
less
you can pull.
straightforward.
And it depends on the planning process. Where how much can you save? Are you jumping tax brackets? What are your deductions as a family? So the more you're aware as a younger individual, the more I think you'll be aware when you're at retirement and things are a bit more fixed.
So if somebody
income side.
because when somebody's retired, they may be getting an income. They may have a pension. They will, have Social Security more than likely. They may have IRA distributions. Some are mandated if they're over age 72 or whatever it's going to be. 3 now. 73?
73,
Yes.
at least for another 9 years.
Right. Okay. So they're going to have those. They may have 401k distributions they're taking. They may have rental income. I mean, I don't know. But it seems to me that people who are retired, they're not just getting their paycheck from their job because they don't have the job anymore.
Right.
So it would stand to reason that it's more complicated. But I would think if a retired person, and I'll speak specifically to them, said, okay, I made $100,000 this year. Where did all this come from? If they understand that, would you guys as advisors say that this is a big step toward making sure that you're getting your information to your CPA? Okay.
I think one of the most confusing parts of the return is if they have after-tax investments where year over year there can be a big change in your income. Because you could be receiving $100,000, but 50 of it came from your trust account, your non-retirement account, where you could have had losses like this year or the prior 2 years. There were big gains, so that changes your income a lot.
Your taxable income.
Your taxable income, your spendable income is the same, but the mix of the money is very different. You include a Roth IRA in that.
There's a lot
well.
of misconceptions where people have mutual funds or other investments that they're reinvesting the dividends. It's in their personal trust account, personal account. And so 2000, as Jonathan mentioned, the 2 years prior to last year were big gain years.
Yeah.
And a lot of mutual funds issued a lot of capital gain that got reinvested. The individual never saw the money. The individual, they've got their investment portfolio at XYZ place, wherever they never saw the money.
A dime.
Okay, well, hey, my portfolio went up nicely, the dollar amount, and then they look at their tax return when they do their tax returns a couple months later, and they're like, what
this?
the heck happened here?
I didn't get anything from
my income went way up. I didn't get a raise, but that distribution, that capital gain distribution that happened at the end of the year is a taxable event, even if you never saw the money and you just reinvested it. And so it's a misunderstanding. I was also talking to somebody who was worried about going $1,000 into the next bracket. Now, luckily, they had the brackets wrong because they went online, they did their research, and they saw they could make X amount of dollars in the 12% bracket. And they were deathly afraid of going over that because they didn't want to have a retroactive 22% going all the way back to $1.
Oh, man.
First off, that doesn't happen.
That doesn't work.
It's only the amount over the bracket. The second thing was they weren't taking into consideration the standard deduction, so they had a lot of room left in the bracket. And so, luckily,
something as simple as
they misunderstood two different things, but it wasn't hurting them. It wouldn't have hurt them even if they went 1,000 over. So, I think I mentioned this earlier. This creates a lot of anxiety that is not necessarily. It's not necessary. You don't need to have this kind of an anxious attitude towards your taxes. Understand them a little bit. Take that anxiety down several pegs and just enjoy what you've got. I mean, it's no need to get upset about it.
Well, what would be for you guys as advisors? What would be the ideal scenario for somebody? Would you suggest that a client, you give them the tax management, they talk to their CPA, and then have the CPA contact you guys, or is that too much, or what? Ronnie, what do you say about that?
Yeah, no, I've offered that a million times over the years, to have clients give my information to their CPA, to have them call me for more complex situations so we can work everything out.
Have the CPA so that because you as advisors will know, here's what the CPA has to know.
Right.
The client may have forgotten, they may not have understood it. Hopefully they do, because part of your job is to make sure the client understands what's happening. But maybe they forgot or something.
Some clients just don't want to know.
That's
a lot.
I hate to say that, but
is
it's
that
like,
a good thing, or
just make sure that I'm okay.
Okay,
and
which you'll do.
Oh yeah, but I still like them to understand what's happening. But some people don't want to take the time to understand it, and there's some complex things out there.
Well, that's true, but you'd hate to see somebody walk. I mean, it's great that they trust you to do all this stuff for them, but you hate to see them walk away without really having any understanding of what you guys just did.
Right, but
right.
It's hard for somebody in that category. It's hard to make them understand It's hard to make them want to understand.
Well, and that's one of the reasons they may have hired an advisor, because they say, look, I'm a small business person. I understand the widgets I make, and I know all about that. I know nothing about the money side, the taxes, payroll, forget it.
Right. They have enough to worry about.
Yeah, and I don't want to worry about that.
And they want to enjoy retirement, kind of like what we talked about before.
Yeah.
These are items they don't necessarily want to spend too much time on.
Yeah. Well, it's important to know that. Before we wrap up, have you seen anything else, Jonathan, that people that need to know about, or have we covered it all? Or?
I mean, I do enjoy when I see a kind of a final draft of a tax return, and I can give them some confidence that what they're submitting is correct.
Like before they.
Yeah.
Oh.
Yeah,
okay.
but I mean that is rare. That is pretty rare that someone's that organized where they're going to get a copy of it.
But even if we get it after the fact, it's nice to tell them, hey, you did what you could do. This is done nicely. There's nothing else you can do. Again, try to reduce that anxiety level about the taxes.
Confidence. Yeah.
So in a post-tax meeting, and you grab somebody's 1040 or whatever, and you take a look at it. Do you ever go along with them and say, look, here's what we could have done here. Maybe we'll do this differently this year.
Yeah.
This law changed.
If we can do something, we'll go through that. So you know what? This number here, if you restructure this, we can bring this number down, which will bring this number here, the one that says, this is your tax. We can bring that number down.
Well, I'm also asking what the next year, is looking like. We want to look forward, not just backward. So it's a good conversation to have on taxes. And, some things last year might be very different from the year ahead.
And you've got a handle on that.
2021 versus
Yeah.
2022,
Yeah.
huge difference in investment returns.
I don't know how anybody could do all this stuff themselves, and I'm happy to have. I'm glad you. I say this to Professor Plum all the time. I'm glad you find this fun, Jonathan.
Thank you.
Ronnie, you guys find this fun too, I would assume. Otherwise, you wouldn't be doing it, would be my guess.
Sure.
Sure.
Well, fun, but it's a challenge, and it's one that you guys are up to. It's a good idea to talk to an advisor. If for some reason you're listening to this podcast and you haven't talked with a financial advisor at Lucia Capital Group, you should do that. I've got a team of them here with many, many decades of experience added up together, if I can say that, in the business. I don't know if I'm allowed to, but it's true. It's true.
Well, I mean, that part.
Well, did you hear how this works, though? Because, Professor, you and Ronnie and Jonathan, you guys are all talking here. Just it happens to be on the podcast. But these are the kinds of things that happen in meetings, away from clients, which is, hey, Rick, I've got this person, and, what do you think about this tax situation?
Well, yeah, Jonathan and Ronnie
Right.
call me. I call them. We're like, I need a new
Every
pair of
day.
eyes on this.
My second job is to bug Rick Plum.
Well, everybody does that, but this is the brain trust that we talk about. It's good to have different eyes on it so that people can say, "Hey, I think this is I got a good idea on this. Oh yeah, let's try that." This is what you get at Lucia Capital Group. Give them a call, 800-644-1150, 800-644-1150. They do not just work in silos, they work as teams. It's a very important aspect of this. 800-644-1150, or go online, luciacap.com, luciacap.com. Find us on Spotify, find us on iTunes, subscribe to this podcast because, hey, this is the kind of information you're not going to get this anywhere else. Be listening regularly to this podcast, and if you have any questions, you can go to luciacap.com and send them to us, and we will try to answer them on the air. Jonathan Savona, thank you.
Thank you, boys.
I do appreciate that. Ronnie Sanchez, same as you, wealth manager here
Thank
at
you.
Lucia Capital Group. I'll mention again, Jonathan is a CFP, certified financial planner professional. And, of course, this guy, Rick Plum, who's here. I can't get rid of him. I did a couple of weeks ago. This is like your first episode you weren't on.
Oh, yeah, when you
I had Chris
Mr.
Lloyd.
Lloyd, yeah.
That's right, yes. But that's fine. I'm very happy to have you here. For all these guys, I'm your podcast host, Johnny Dean. Thanks so much for listening. We will talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. No client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Before investing, carefully consider an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Rick Plum, Jonathan Savona, Ronnie Sanchez, and Chris Lloyd are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.